record. I should be recording. Few more people coming. 2 more. Who's new? Syra, Sahil, AK, Adam. Adam's tuned in. Few more. Come on. Let's see. I can see Omar is on FaceTime. Someone's in bed. Okay, let's see. Okay, that's fine. All right, guys, let's get started. I think 17 people should be all right because I don't want to take too much of your time today because this should be a pretty quick topic to cover. A lot of you who are getting confused as to what hedging is and how you can even use this for your own trades. Maybe some of you are trading independently. Maybe some of you are just following signals. Best thing to understand first and foremost is that hedging is a way of re-entering trades and also trading narrow market conditions. What do I mean by narrow market conditions? What I mean by that is, for example, start of the week, this is where I send the signal on USD JPY. I sent the signal for USD JPY when the market opened and I said possible sell from 108.500 and I had the stop loss about 10 pips away. As always, we're always keeping the stop loss minimal and your TPs as much as possible. So some people think, I'm hitting stop loss, I'm hitting stop losses. Those of you are panicking when stop losses are hit. Look, this is the amount of risk, this is the amount of reward that we're working with. So do not panic if we hit stop losses. As long as they're using the same lot sizes, you should be okay. But we don't want to get into money risk management. Again, it's all about hedging. What do I mean by that? In hedging, if the market was to to keep on trending, going up and up and up, it wouldn't really be so efficient because you're just gonna end up losing a lot of pips or depending on market. But so you need to understand when to enter and when to not enter. So first thing and foremost is if you take this entry, your stop loss, where is it? Is there, and your TP, I believe I set it at, let me just confirm, start of the week for USD JPY, I believe it was 108.3, but I'm not 100% sure. Just make sure that is the case. 108.3, yep, and 108.00 was the second take profit. So the second take profit was around this level. So that's the second take profit. But we know that the market is not really gonna bounce straight and then come down to TP2. Normally, when you do see the signals that are sent, what you really see is the market goes and hits TP, then goes back into entry level, then it comes back down. Sometimes I say re-enter, sometimes I don't, sometimes I may have missed out, sometimes I may have been sleeping, whatever. So if you are missing out on this opportunity, what happens is that what has the market done? The market has come and hit TP1 and it has reversed back into entry level. Sometimes it drops really quick. But the timing that it takes the market to go to TP1 is very important. If the market, the signal was sent and within a few minutes it has hit TP1, we can expect the market to move much stronger in the coming few minutes. Maybe if I sent this at midnight, so about 12 o'clock. If I sent it at 12 o'clock, you know that this is right now Asia market conditions. So you're talking Australia and Asia, they're the ones who are awake. They're the market makers who are going to be making the most moves around that time. London market is closed, so is New York market is also closed. So the next day, they're going to start coming in around 7 o'clock. So what we can expect in Asian market conditions, if you look back on the charts, you'll see that a lot of the movement happens around when London markets open and when New York markets open. So in Asia, you see a lot of consolidation. What consolidation means is a lot of ranges. Just observe the chart. You'll see that at midnight, usually speaking, there is not huge, great moves that happen. But unless something key, for example, fundamentals, a report or something of that sort gets released, that's when you see a big move. In this case, you see a USD JPY. This was sent on Monday. So this was sent on Monday at 12 o'clock, Sunday evening, Sunday about 11, 12 o'clock. So that means, what can we expect? The market is going to be pretty dead. The market has just opened. It opened up with a huge gap here. So most likely we're going to see a bit of retracement to try to fill this gap up. Sometimes it happens, sometimes it doesn't. But we can see it's a huge gap. Market has hit this resistance level. I'm not going to go into how I plotted this resistance area, but 108.5, we plotted this out. And say, for example, this is what you see on your charts. So when I do send a signal, you must, if it's a sell, you need to assume that this is a resistance of some sort that I have plotted. Even if I don't send a analysis alongside the signal. So just assume and open up your own charts. Have a look. Don't just sit there and rely on the signal to do everything for you. That's something that a lot of people are making the mistake of, just sitting there and just expecting the analyst to say, re-enter now, take your profit now, put your stop loss here, put your stop loss there. Use your own diligence. Try to understand, try to learn yourself, because if you don't learn and you're not making efforts to use signals alongside your trades, in the long run, what are you getting out of trading? Are you just looking to blind trade your entire life? You know, it's not really a good way. So just try to understand, try to put your diligence. If someone is selling from 108.5, there must be some sort of resistance there. So assume that. Now we're trading in Asia, Asian market conditions. This is the first TP. We now know that Asian market conditions, we're not going to see a huge drop. Why? Because Asian market conditions are the least volatile out of all the trading sessions. So Asia and Australia right now, we can expect the market to come to first TP and reverse back up to entry level. But look at this. Pips wise, from here to here, it's 20 pips. And from here back to entry level is 20 pips. Now, if there is TP1 and TP2, most likely this trade we are assuming that it's going to have a long-term potential to go to TP2. It doesn't always mean that it's going to hit TP2 straight away. You may see it TP1, get a quick reversal, go back to entry, then come back. Maybe the next day we may see the drop to happen here. Maybe even take up to the end of the week, because this happened on Sunday. We had Sunday is the least volatile trading day. Then we have Monday, which is also pretty slow. Then you're talking Tuesday, which the market tends to warm up. Wednesday and Thursday, we have a lot of volatility. And also Friday this week, we had NFP. But normally Friday speaking, the end of the day, end of week trades tend to get closed out. So we have to kind of plan ahead when you see it for the start of the week. Don't just think that at the start of the week, boom, we're going to see a massive drop. Try to kind of envision what's going to happen. Tuesday, what's going to happen, maybe a few ranges. Maybe then after on Wednesday, we may see a big drop. Maybe on Friday, we may see a big drop. Maybe during the week, we may even see the escape of this happening outside of this zone. If it hits TP, comes back into TP1 area, we may see the breakout of this resistance. Always look at the worst case scenario. The worst case scenario is your stop loss being hit. Do not always think about profits. My TP is going to hit, my TP is going to hit, my TP is going to be hit. If you do that, what is going to happen? You're going to be hit with a shock when your stop loss gets hit. But if you're aware and you're thinking, okay, my TP1 is going to hit, then maybe the next time when the market comes to entry level, if I re-enter again, market is going to hit my stop loss. So plan ahead and think where your next entry point is going to be if the market hits stop loss on your most recent trading. Going back into that, I want to again go into where you could have potentially hedged. Hedging areas, I'm talking about the reversal, the quick reversal that the market would have done from this area, from your TP1 area. It comes to here, say for example, this is in London. So around 7 o'clock, 8 o'clock in London, and we see the market has come in all the way down. We can potentially get a quick reversal around this area because we can see the market has dropped quite a bit for Asia. We may see a quick reversal, maybe about 10-20 pips up before we go down to hitting TP2. So it doesn't hurt us to put a little position to go the other way. Maybe this hedging position can also be dividing your initial lot size. So if you're using maybe 0.05 for your main positions with a £500 or £1,000 account, right? Your hedging positions could be maybe 0.02, which is half of 0.05. So don't do hedging positions at the same risk as your initial positions, because the initial positions are your strongest ones. Remember that. Your secondary positions are your hedging positions. So that means that this position that you take here is going to hit profit, but when it comes back, you're putting another positions at this area with a 10 pip stop loss to go back to entry level. If it does, great, you got caught a little more pips. But if it doesn't, you're not losing much either, because the moment that this trade goes down, so the initial trade is traveling down, you're still in profit here. You're still in more money. All you're doing is lost a few extra pips around this area when I said hedge trade for the opposite direction. So if this hedge trade does get executed, because normally speaking, the hedge trades always have about a 10 pip stop loss, 10 pip with a 10 pip stop loss and a 20 pip TP or some sort of that. So if this trade does take off and we are in 20 pip profit, do not also close the hedge trade soon as it comes to the entry mark. Why don't you let this trade, open, keep that open whilst this trade is possibly breaking off at break even. You could enter this trade again for a sell, 0.05 trade, go again for a sell whilst this hedge trade is still open, because if this trade does lose, this trade can continue the rise up to the next resistance level at 109. So in that case, this loss that you would have made, it really has this has softened the hit by keeping that running. So if you do end up closing it, what's going to happen is now you're going to be out of position on USD JPY. But if in this case, what you've done, this would have hit on break even. This would have continued to keep going on to the rise. So what happened initially was this. I want to play the whole scenario out. So this happens, came back in, then we hit 0.05. The first TP was hit around this area. But so around this area, what time was it? At 1 o'clock. Now, I didn't tell you guys to add a hedge position at that time. I could have, but I didn't, because I think I went to sleep. But like I say, if you all used your own diligence, what you could have done is be like, okay, it's the Asian market. The market has dropped down about 25 pips. It's quite a big move for Asia. I could maybe put a 10 pip stop loss trade with a 10 pip TP, look long position, a little stop loss, 10 pip TP. I'm not risking much. I've hit my first TP, which is 20 pips. But what I'm doing is I do a little hedge position. This hedge position, if it does take off around this area, I could move the TP up and then move the stop loss to break even. So if it does go up to this level, all I'm doing is I'm catching the reversal back up. But if the stop loss does hit for this trade, for the hedge, what happens is, you're not losing out on any pips, because this initial trade, so this is the initial trade, I'll show you now. From here, 0.05, we're in this much profit, right? This was a stop loss. Now, this trade is active, but this trade would have been active. The second trade would have been active because the first trade would have closed, but you would have opened this at this rate. So, if you had 25 pips, I may see a market go back to entry level, because TP1, usually you don't hit 2 TP straight after the other. You could have waited until a few more hours, maybe mid-Asia, around 2-3 a.m. But I'll show you what happens. So 10 pips here. All you're doing is covering back up. If it goes back to that level, you could re-enter and place another position. Whilst at this time, this TP would have been extra 20 pips. So what would have happened? Let's see. So it would have came down. So we've seen a bit of reversal around the area there. The market goes back. Now this would have hit your 10 pip hedge trade stop loss. So 0.02 would have hit stop loss, whilst the 0.05 trade would be what's happening. It would still be running. It would be standing in extra profit right now. What you could have done, see what happens. So maybe another 0.02 hedge position to go back into entry level, because this is still Asia. How often do we see, in Asia, 2 TPs being hit one after the other? Very, very unlikely. So we put another trade, a hedge position. Now this hedge position from here will be calculated at your stop loss rate. And now your TP is what? Your TP is going to be back to all the way to your entry point, with your stop loss where? Stop loss at your second TP for your initial trade. When you do that, what happens? If this trade does go all the way back, you're not losing out on anything. You're just catching the reversal. But if this trade does hit stop loss, your 0.05 TP2 gets hit. What are you losing? You're not losing anything. So initially, this trade is more profit. You're just trying a second hedge now. Again, money risk management and your lot sizing is very, very important. Do not forget about the lot sizing and think that you're going to use the same lot size on your hedge positions as your major prime positions. going in. This time round, it takes off, goes back into what happens. Now, at this stage, you can just let the market run. Look, the next day, London market makers come in. Now, this time round, what has happened? If you are a guy who did not take the hedge position, 2 hedge positions at that time, you would have actually missed out on this huge rise from where 34 pips. You would actually call more pips here than from there to there, right? But now your TP2 for this trade would be what? At break even. But this trade that you initially made is about 34 pips. So you'd have made the loss up from that 0.02 loss that you've done. And all you could have done when it comes back into entry level, close it. But when you do close it, what you could have done is open the new position of 0.05 and take that short again from the initial prime entry point. Yeah. So you do that again. So you don't expect me to tell you, take a position again, take a position again. If there is a trade that you see the market has from the last day come back down, come back to entry, and it's the start of a new session, try to re-enter at that time. Take a risk. Try to initiate to learn to trade yourself. That's the first point of you becoming an independent trader. If you don't want to become an independent trader, you're not going to succeed. Yeah. In signals, no matter how good signals are, I've had times where I had 2,000, 3,000 pips a week from majority of the mentors. I had weeks where we had 700 pips from everyone. Yeah. Both weeks, people are losing. Some people are losing regardless of why, because people are thinking that signals are the way forward and learning to trade yourself is a time waste. If anything, it should be the opposite way around. The people who are making the most out of my signals are those who are learning to trade themselves, the course clients specifically I'm speaking about. So, like I said, I'll go into hedging in much more detail, but this is just a small example of how you can do it in USD JPY, which is a signal which was sent. There are many types of trades. So the same hedging position, it works in a market where it is narrow and ranging. For example, this market was ranging for a long period of time. Look at that resistance on 108.5. These are multiple opportunities you could have actually re-entered throughout the whole week before USD JPY fell because of USD JPY actually rose up later because of the positive NFP. But like I say, it ranged for quite a long period of time, this area that we have. If you learn how to trade this, right? If you knew how to hedge right and go up and down, just using that one signal, this signal USD JPY, you could actually hit your weekly target and called it a week. So do not always look for multiple opportunities. Try to see if there is an opportunity to ascend. Go on and do an analysis on that chart. See what happens. See what you see. After you do that, maybe that one pair, one signal could be you done for the entire week. That's the level that you should be coming to. You don't want to be coming to thinking, I want to get more opportunity, more opportunity, more opportunity. And in the end, what happens? You're going to just blow your account. You're just gonna, because of greed, because of fear of missing out, because of all those factors which happens to beginner traders. So you guys specifically, I don't want you guys to do the same mistakes, but hopefully hedging it clarifies a bit more. So narrow market conditions, use hedges along the way of TP1s and TP2s between those areas, and risk little on those money risk management wise compared to your prime entry points. So even if you do lose hedges, you're not going to get hit big time, right? And also, even in this case, you could have maybe seen how the market reacts around the 108.5 level. So if the market does break this area, you could have left the hedge running as like a little swing. So the swing could be taking place because this market breaks. What would happen? Go above, break, retest, and we could have been landing here if you had kept this single hedge open. We could be looking at from here all the way to the top, 85, 86 pips. That's what you see sometimes we do in especially gold. Gold, I send a trade at the top and I send a trade at the bottom. And all I did was just let the one in the bottom and the one at the top run. And when they run, when they break a major resistance or a support, I just let them run to the next area. And all you do is just wait and see when it gets taken up. For example, XAU USD. This was a case that I did start of the week as well. So let me just get another review. So this, I believe around here, I sent this hedge. So this was XAUSD gold chart. Yeah. So when gold rose up all the way from 1400 all the way to 1434. Around this area, I sent a signal, and that signal came and it dropped really quick. When it came to here, I said add a hedge position for a buy. Then it came back to this area, I believe, and I said add another position for a sell. So I'm expecting this trade, it actually hit TP, this trade to continue going down, whilst this trade is going up. So what am I doing by doing this? Let me just show it to you a bit more neater perspective. So we've got a long position, that happening, and we've got a short position, which is here from here, which actually hit TP, which was also really tight stop loss and trade. And we had also, which one? I believe this sell that was going, yep, this one. Now, with this trade, so using the wicks, let me just make this a bit more clearer so you guys can understand properly what I'm talking about. So my thought process, what do I want to be thinking of this scenario? Let's look at this. So this is the first position. Let's forget about this. Let's forget about him. I'm sending a sell trade at 1344, 1433 something. So I'm sending this as per sell. What happened? Market goes in, hits first TP or second TP. So how many pips does it drop? Let's look at this. It drops quite a lot of pips, about 100 pips the market dropped. And this is in Asia. So I'm thinking again, Asian market time, the Japanese traders, they've actually pulled gold down this low. So what I'm doing is, let me add, whilst this trade is still open, because I'm still having a big scope for all the way down, because gold actually rose up, and my analysis on gold did say that I got more long-term downfall. So now I'm adding a hedge position the other way as soon as it hits my first TP. So what this does for the buy is, if the market does go the opposite way, right? It does go the opposite way. Where are we heading? We could be heading to possible 1445 handle, because what happened is we just broke the 1400 handle. 1400 handle is all the way here. And between the two, we got 1425, and above that is 1500, right? 1500. Those areas that I have, key psychological areas. I'm expecting, if the market does go the other way, I can expect this little hedge that I have to possibly keep open. This also depends on what your money risk management is, and also what you're expecting to get out your trades, and what your weekly target is. If your weekly target is 200, 300 pips, do not be greedy. If your weekly target is 1,000 pips, maybe you need to trade with long TPs. So it doesn't work for everyone. So try to create a trading journal which says how many pips you want to catch a week. If you want to catch a certain level, you have to stick to your target. So me, personally speaking, by this time I already hit my weekly target. So all I was doing is to see if I can keep a trade open and close out the next week, which is on Sunday. So I'm thinking, let me just keep it open. Whatever happens, it happens. So this either takes off, we go back, and I can close this trade next week, or either this trade keeps going down, I can close this trade on possibly, 250, 300 pips or so. So either way, I'm not losing out if this happens. Yeah. So this is what I did a couple of weeks ago. Some of you may really know that last week before last week, my overall was something crazy. It was like, what was it? First TP. So my overall, as you can see, XAUSD 200 pips TP1 and 190 pips for TP2. So that's about 390 pips that I actually caught just by doing that, just by doing this hedge. But this hedge did not work so amazing, except one trade which I left order running. So this, what happened is I bought here. What happened? Look, now we are going up. We'll actually hit TP1, but I'm expecting it to reverse. Reversing. We are fighting around again to the initial area that we had, the initial high there. Now we're matching up with that initial high. So what happens? This is now 2 a.m. goes back. Both of my positions are open. So this area, this position is open, this position is open. Now I have to determine what can the market makers potentially do. They can either break this area and go to this level possibly, or come back midway around here and reverse. That's a possibility. Or from here directly drop down. This goes into profit. All these potential scenarios can play out. But either way, I'm still at this stage. From here, I'm in break even. By this position, I'm in 110 pips. I could either close both my positions and call it a week. But what I did was see if the market either breaks through, goes straight, or from here goes through directly to here. Those are my two possibilities. But the market didn't do either. It did something different. What it is, goes back. You'll see that the market actually comes back. You'll see later on. Let's see. 5 minutes. So we're ranging. We're still both did this. Now this sell trade looks like there's more downturn potential. Look at this. Now we're coming back all the way to the end of the week. Because 5 minute candles taking quite a bit of time. But you can see if you had implemented it, look, now we came back all the way from this point. Oh, fine. Remember gold, it moves a lot of pips here. So how many pips did the market actually move from the initial entry point? Initial entry point was around this area, 1434. We go back, we went to 1437. So this is about 40 pips that we escaped. If you had your stop losses initial signal that was sent, what would have happened is you would have probably got taken out around that point. But if you had re-entered around here, you would have probably been in a better situation. And you could have actually kept this initial trade that you had and just let it ride, because one order, sorry guys, one order that I had, this order, some of you I showed, let me see, actually put this up. This was the XAE USD order, 1430, 1397. So this, the initial high was 14397 was the high that that came up to here, about 70 pip drawdown. But this, like I said in the initial, I still believe that it's going to have a much more downtrend. So I closed this around 1397. 1397 is my support area at 1400, just below 1400. That's what I closed this trade. So it came back down all the way to here. But either way, if the market did go all the way to here, I had that trade covered as well. So there, I'm adding multiple positions even during this whole time. What is this? Yeah, during this whole time, I'm adding small hedging positions. Those are the positions that hit stop losses. For example, this small position on the buy, 10 pip stop loss, 10 pip stop loss. In the long run, this makes it seem pretty much next to nothing. So this is hedging. Hopefully you guys understand the long-term reasoning for hedging and also the short-term reasoning for hedging. The USD JPY was an example of a short-term trading example for hedge, and this is more for long-term holding and working with trends based on what your analysis on the higher time frames say. Hopefully you guys like this webinar. It ended up being a bit too long. I did expect it to be about 30 minutes. I don't think it has been 30 minutes anyway. But yeah, I want to cover a few more topics maybe in the next few webinars. If you guys did enjoy it, just post on your mentorship chats how you found the chat. And yeah, I would want to hopefully do a few more as we go along. So you guys have a good day. It's good trading week this week. I may be doing also weekly forecasts from next week for trades and your whole setup, so you guys can also see what I'm seeing in the higher time frames and not just the shorter time frames when you're trading in the little signals, because that is really, really important, especially if you want to learn how to hedge. You want to see what I'm seeing and also learn to trade independently. Have that also a goal, no matter who it is, whether it's with me or someone else. I'm not telling you to come and do my course. I'm not forcing you guys to do that. Go and learn anyhow, and then look to put your time and effort in to learn yourself. So Any questions? Just leave it on the mentorship chats. And if you guys did like the webinar, I would really appreciate it if you could give a little feedback, and it'd be amazing. So as you can see, I'm struggling to talk now. I'm not really used to talking for 35 minutes on the mic. But yeah, guys, have a good day. I'll see you guys really soon.